The biggest change that we've seen is the maturity of the space. And that has been brought about by the combination of institutionalization of crypto markets as well as regulation. The buyer base has sort of changed. And what that sort of has meant is that not that retail essentially has become less, it's just that now the size of demand, a large proportion of it is coming in from institutional side. We saw it very recently when we saw the kind of market-based volatility. ETFs tended to be a lot more stickier. That space will just naturally converge towards where the existing kind of advantages lie. And crypto has the advantage of just being a lot more quicker and providing that convergence area, but that will be catered towards the audiences that currently deal and operate on crypto platforms. I think all these adoption cases that are happening, the important point and takeaway here is that it's essentially onboarding a lot of liquidity on chain.
Hi, everyone, and welcome back to another Binance Masterclass, sponsored by Binance, of course. And today we're joined by Moulik Nagesh, research lead at Binance. We have a great conversation for you today. I'm really excited for this. Malik, how are you doing today?
Thanks, Bijan. Really excited. And I'm doing well. How are you?
Doing fantastic. Yeah, I know our audience is definitely looking forward to this conversation. Anytime we have someone who's deep in the weeds at research in this industry, especially at a giant like Binance, it's always an interesting conversation for us. So really quickly, before we dive into it, Malik, for the people who may not be familiar with you, can you give us a, kind of a quick overview of your role at Binance and, kind of the data that you come into contact with day to day?
Yeah, of course. So I'm essentially the macro research lead at Binance. We're kind of a lean team, but we focus on various different kind of sectors across the space. So that includes sort of very kind of much macro-based. We look at industry-based kind of metrics, as well as deep dives on a bunch of different kind of thematic focuses. So whether that's sort of like stablecoins, it's like DeFi, it's kind of layer ones and so on. So it's kind of like very much kind of across the board. In terms of the metrics that we look at, we're really looking at kind of macro-based metrics. So like things which are very much like usual day-to-day institutional-based, TradFi-based metrics that are kind of common. But we also kind of combine that with very much like on-chain based metrics. So we're looking at kind of like stablecoin flows, on-chain based liquidity. We're looking at sort of liquidity from new asset classes, asset-based vehicles such as ETFs, kind of digital asset treasuries, and so on. So very much kind of like combining both the worlds of TradFi and crypto and kind of bringing that together.
Yeah, I love that. Raul often says crypto is macro, macro is crypto. So, what you're doing is a great description of that. So let's dive into it, right? Because you are uniquely positioned to really know kind of what's going on in the markets. You can see what the data is telling us. So where are we now in the current market cycle? Like what basically what I'm trying to say is what actually defines this current market cycle and like what to you feels different in this market versus previous ones?
Yeah, definitely. So, in terms of, I guess the biggest change that we've seen is the maturity of the space. And that has been brought about by the combination of institutionalization of crypto markets as well as regulation that's provided a lot more clarity to the space in overall. So what that has really meant is that the buyer base that we've sort of moved from a space where it was very much retail driven, and now it's kind of focused more towards the institutional side. And that's kind of changed kind of essentially the demand-based structure of what we're seeing. What that's resulted in is just more kind of let's say more mandate-based purchases of cryptocurrency. We're looking at sort of overall declining trends in terms of volatility over that horizon. That also sort of includes in terms of how Bitcoin is kind of viewed as a macro-based asset class as well, and portfolio inclusion. So I think that's been a very big kind of change where before it was sort of still a very early asset class in terms of we didn't have much data points there in terms of how best to judge it. I think there were a lot of different kind of trends and notions that were essentially going on about that. So whether it was sort of an inflation-based hedge, kind of a debasement-based hedge, whether it was just like a speculative asset and its correlation with kind of risk on assets, that has sort of kind of formalized towards Bitcoin being this sort of macro-based asset that provides enhanced risk-adjusted returns. And its correlation is very much regime dependent. And that is sort of something we're seeing in terms of portfolio-based inclusion. So when we look at sort of your institutional like buyer, uh, they're really much kind of kind of valuing Bitcoin in terms of how they end up going about actually sort of allocating a purchase. So that's something which I think wasn't there before. And it's really much changing the kind of like the buying based structure in this market. And then naturally, from Bitcoin, I would like to kind of touch upon altcoins as well. I think in previous cycles, that was very much highly speculative, and there were very much a lot of different narratives in the space. Nowadays, it's become a lot more selective. I think there's a massive kind of drive towards a return toward fundamentals in terms of how we value altcoins. That space is still maturing. It's something which I think will be a key kind of focus point for the rest of the year in terms of value accrual for a lot of these altcoin-based metrics. But overall, the take there is that it's very kind of positive for the space in terms of how we get towards a more mature market structure. And then the final piece I'd like to also say in terms of the differences, and I kind of touched on it before, is just the liquidity side of the market. So I think now we have a lot of different structures from whether it's stablecoins, there's kind of ETFs, there's digital asset treasuries. These are very much key drivers of liquidity in markets. And that's something which becomes important metric to track as we kind of navigate and move forward in the space.
Yeah. So I want to kind of touch on that because, you mentioned institutions as well. And we're also seeing governments come into this as well. A lot of big players, which is also, fundamentally different, feels at least from the last cycle, right? And kind of when we look at also what's going on, like just geopolitically, all the chaos in the market, right? During this time, like we had just massive inflows still in the ETFs versus the SPY kind of, being very volatile. What do you think that set? Like, are you kind of seeing Bitcoin becoming like a hedge against kind of, these types of environments? Or is that also different from what it was last cycle? How are we viewing this now?
Yeah, that's a very good question. So the first thing I would like to say to that is I think it's important to remember that Bitcoin is still a very early kind of asset class. So when it comes towards the data points that we have, they're still relatively limited compared to kind of your traditional assets that you see. So that has naturally meant that in terms of the opinion to what Bitcoin essentially is and crypto is, that has also kind of evolved, and we will still continue to see that evolve over time. So when it comes towards Bitcoin, I think what we can extrapolate is, in terms of previous data, is that it's a very much sort of a risk-adjusted asset class in terms of providing enhanced risk-adjusted returns. I think we're seeing kind of in a traditional 60/40 portfolio, there's this drive for a 2.5% inclusion or so on, and we're seeing that drive really much kind of come and take effect from various different kind of asset managers across the space. Now, in terms of correlation, I think we've seen sort of various different trends there. Initially, Bitcoin was a lot more kind of diversified in kind of let's say pre-2020 or so. Recently, with institutions coming into the space, it's very much kind of been short term. It reacts in terms of being kind of risk off when there's kind of stress-based episodes like we've seen with the recent kind of geopolitical tension. But then in the longer term horizons, it tends to sort of act as a semi kind of diversifier as well. And that's purely just because the perception of the asset class is very different. It still holds kind of structural differences, whether it's kind of its supply-based metrics, halving cycles, and so on. So it naturally just provides a bit of diversification towards the traditional-based equities. But I'd like to kind of like go back to my first point is that kind of take is very much evolving. I think we've never really seen Bitcoin operate in an environment where, we've had geopolitical volatility. We haven't kind of seen Bitcoin where we've sort of had like high interest rate environment. It was always where interest rates were pretty much near kind of like zero or zero bound rates. So it's something which we're learning. And I think as kind of we evolve towards the next kind of macro-based regime, these data sets will evolve and we'll essentially be able to see a better kind of viewpoint and picture towards what exactly Bitcoin and its role in terms of a asset class.
We mentioned, right, we're still sticking on this institutional level with Bitcoin and just crypto in general. Like last cycle, it was like retail was driving this, right? Or at least that's what it felt like. But now it feels like it's the businesses and the governments kind of driving what we're seeing now. So what is happening, or I guess what happens when retail is no longer that volatility engine? Is that what you're seeing now? Or so basically, yeah, what happens there?
Yeah, it's a very good question. So the buyer base has sort of changed, and what that sort of has meant is that not that retail essentially has become less. It's just that now the size of demand, a large proportion of it is coming in from institutional side. I think we saw it very recently where, even this, like when we saw the kind of market-based volatility, ETFs tended to be a lot more stickier. I think we saw the market drop by around 30 or 40 odd percent. But at the same time, the kind of the asset under management for ETFs had a much kind of smaller marginal base drop. And that just reflects that institutional capital tends to be a lot more stickier and less reactive, and is more based on kind of mandate based purchases and just fundamentals. So they will make their purchases a lot more on whether fundamentally the demand holds and whether it still makes sense. Whereas retail tends to be a little bit more speculative in terms of reacting to different kind of market-based regimes. In terms of whether it's changed, because of that composition, it's just meant that volatilities essentially become a lot less from the space. I think we've kind of naturally seen it. In prior cycles, we had a lot more kind of peak to troughs, but now it's very much like not as significant. And I think that's also kind of reflected towards the division we're seeing in Bitcoin dominance. So when we look at kind of institutions, they prefer your kind of harder asset class. It's more mature when it comes to Bitcoin, the largest kind of market cap in the crypto markets, whereas altcoins have taken that kind of retail-based hits, and the reactiveness still exists in that market. So that's basically the symbolic nature of the differences in composition of demand.
Yeah, we're seeing it even today in the price action, right, where Bitcoin is leading that. And I want to ask you, because so we know the ETFs are buying up Bitcoin and even ETH, right? Do you see that expanding out the risk curve into other prominent L1s?
Yeah, and it's already sort of happening. I think we've seen kind of Bitcoin obviously being the first kind of ETF to kind of unlock that trend, and then Ethereum naturally following. But now we're seeing we've already seen kind of Solana based ETFs being approved. There's kind of a push for BNB based as well. So that's naturally evolving in terms of whatever asset class, whether it's L1 or something which let's say has a strong value accrual mechanism, and generates strong revenue, utility, as well as fees. I think those are essentially the crypto-based assets that will naturally evolve towards ETF-based structures as they just become more attractive for institutions wanting to own and adopt them, and ETFs provide that natural gateway for them to actually enter that market.
Yeah, and that's actually segues us kind of into the next topic I wanted to discuss, which is L1s, right? We know Bitcoin is king, right? But how would you describe the state of the L1s in today's dynamics?
For this one, I'd like to focus mainly on sort of just the overarching trend that we've seen from maybe the early days of crypto and then where we are today. I think for a long time, it was more about just general purpose L1s, where I think we had kind of Ethereum start that trend, but then there were a wide variety of different kind of just smart contract platforms that were essentially doing the same thing and trying to compete with Ethereum for liquidity. They're competing in terms of just general activity, whether it was for trading-based volumes or even just general decentralized applications. Now, I would say that that notion of trying to compete with each other is slowly becoming a lot more kind of converged, where I think naturally a lot of these chains are becoming more consolidated towards one particular niche and specialization. And that trend is kind of what we're seeing with kind of the major ones, as well as the new L1s that sort of are coming entering the space. So from like the earlier days that we were seeing Ethereum, I think that's now naturally looked at more as a settlement-based layer, DeFi-based liquidity, as well as providing kind of a lot of security. Whereas when we look at more towards, let's say, BNB chain, for example, that's providing a very good funnel for retail-based kind of audiences to go from the exchange side and be onboarded and utilize kind of more decentralized-based applications. It's also providing kind of asset-based discovery and price-based discovery with taking BNB chain as an example. There's Binance Alpha product, so that just provides a lot more kind of discovery for different tokens that first emerge on these chains, whereas not being listed on kind of centralized exchanges. And then you also have Solana, where I think their moat has been a lot more towards just like trading-based volume and then throughput, as well as just having a very good kind of UX-based layer to provide entry to a range of kind of different applications. So we're seeing this kind of slow kind of consolidation happening, and that's also led to kind of the emergence of app-based kind of and specialized layer one. So whether it's Hyperliquid with their own chain, we have kind of Unichain on that side, and then more recently, stablecoin based change in terms of like arc and tempo. So very much, I think the space is moving towards more of a place where less so of general purpose, but more towards specialized in application specific layer ones.
And how do the institutions think about this when they are like buying up stuff for an ETF? Like, do they have that particular kind of use cases in mind? Like, Binance distribution layer. So I'm specifically accumulating it for that use case. And then Solana because of the throughput, Bitcoin store of asset. Is that how they're thinking about it and like their reasoning behind accumulating it? Or is there kind of more to it than that?
Sure. So is this the question around accumulating the sort of the native asset of a chain? Is
Correct. Yeah. For like, when they're accumulating for their ETFs, right? And they're adding into their portfolios.
Yeah. Yeah, exactly. I think a lot of it is based on fundamentals and whether there's strong value accrual mechanisms towards the token. I think that plays a very kind of important role. And naturally, I would say that, network-based activity, applications based on the chain, and sort of just how much to kind of fee these chains essentially collect. That's just a natural indicator towards whether it's something which is generating revenue, and that translates towards value accrual back towards the token. I think another important metric is kind of just more less so on the demand side, but also on the supply side, which is important to consider. So you're looking at kind of token-based emissions, what the inflation metrics are, and so on. But I would say overall, it's still quite an early space in terms of institutions wanting to adopt these sort of tokens. I think they're still building out their mechanisms for how they value these structures. And we'll probably see and likely see a lot more kind of transparency and kind of like token-based like investor relations exist, and just a lot more classifications towards how these tokens are essentially valued going forward, because that has also evolved over the course of time in crypto markets.
I want to talk about actually this as well, because, with ETH as the settlement layer, right? We know, Solana is always kind of, with their, always advertising their speed and throughput, and you mentioned something about, Binance kind of as, this distribution layer. And I wanted to talk about that because it is very interesting. It's actually I haven't really thought about Binance in that sense, right? But, you guys have this centralized exchange, this DEX funnel, you have the asset discovery. Is that actually kind of the most underrated advantage of, an L1? Like, can you talk to me about that, how Binance is uniquely positioned in that distribution layer?
Yeah, that's a very good question. So I think that there are these unique advantages naturally when you specialize towards certain areas. When we speak about sort of Binance and BNB chain, I think that the strongest moat there, and as you kind of put correctly, is sort of the flow between a centralized exchange, liquidity, as well as a decentralized exchange. And that provides a natural kind of just a new point for asset-based discovery. And that conversion just becomes a lot easier as well from a UX perspective. That probably is quite a strong moat when it comes towards having L1 linked towards an exchange that can provide that kind of distribution layer. And that naturally also just stems towards, when it comes to distribution and engagement, it just is a lot more beneficial towards that kind of, like L1, just to have that kind of roll up from liquidity coming from different sources and angles. When it comes towards the asset-based discovery side, yeah, I would say that, when it comes towards the alpha-based product, that has provided a lot more kind of discovery for many different types of tokens, as well as a strong kind of liquidity layer for retail to get access to these tokens very early on. That also exists on other chains as well. But it probably isn't as kind of maybe structured, just because of the fact that it comes from a more, let's say, of a formalized product base rather than just a general just on-chain kind of asset being listed.
Now, and I like the way we talked about this at the beginning of this segment, because I often heard the criticism that a lot of L1s were being built for a demand that wasn't necessarily there, right? And it kind of makes sense to kind of consolidate it and focus on ones that have been successful, have a proven track record, like the Binances, Solanas, and ETHs of the world, right? That can show us that they're specializing it. But where do you see kind of this chain specialization ending up in 3 to 5 years? Is it one layer, like, ETH is the dominant settlement layer? Are people going to be using others? Are there going to be a bunch of execution chains that kind of support this? Or is there kind of going to be genuine fragmentation between this? Like, hey, I'm just Binance can do everything that I need. Solana can do everything that I need. How do you kind of see that playing out?
Yeah, I think that's a very good question. In terms of how that sort of is happening, that consolidation is already in effect. I think fragmentation, as it kind of put it, was one of the big drivers and reasons for it as well. It doesn't create a good UX overall, and it also becomes a lot more efficient if liquidity is in one place, and that just helps enhance the kind of the composability of DeFi as well. I think it gets trickier when you have a lot of different bridges. There's also security risks to do with that, and that's something which I think has kind of pushed towards the consolidation aspect, but also just naturally in terms of where liquidity has gone and the demand and user base that's kind of accrued towards it. That's also been a major driver. In terms of where that space will be headed, I think consolidation will just be a natural kind of endpoint for it. And specialization is probably just going to be the end product game where you'll probably see in terms of liquidity, there'll be very specific use cases on a particular chain in terms of what's sort of happening there. I think each chain also will very much depend upon their scalability aspect in terms of where that execution side is happening. So when you compare sort of Solana compared to, let's say, Ethereum, for example, the technology is built very differently. Ethereum required, layer twos and all these things to sort of come into play just because of the fact that they were suffering on the scalability side on the base chain. And now that's naturally evolving just because of the value accrual argument. But Solana, for instance, just always had kind of natural throughput, and same case with BNB chain. So within ecosystems as well, I think there's also different layers of fragmentation. But eventually, what we've seen so far, all trends kind of are pointing towards more consolidation.
So, a quick break in your regular programming. If you're serious about your future, grab my free report called Prepare for 2030. I think you've got 5 years to make as much money as possible, and this guide will help you navigate what's coming. The link is in the description. Download it now.
Yeah, and it makes, honestly, as someone who's using it every day, it makes so much sense. Bridging is a pain. Different UIs can be cumbersome to use or just a bit clunky, right? So it does absolutely make a lot of sense, especially if we want, kind of that adoption and we want this to be the future financial rails. So let's kind of talk about that, right? As we kind of move to a more consolidated financial system, right? And unified in a sense. What does that look like, essentially? Like, what does that world look like when, we have this, we don't have this fragmentation and we are consolidated? What can, kind of the average user of this, financial system expect that to look like?
I think that's definitely a key theme in today's market. We're seeing a very much like a convergence of the spaces. And that's something which will continue to be a key theme going forward. So naturally, I think it's conversion happening from both sides. We're seeing kind of, for example, crypto being built on TradFi-based rails, and then we're also seeing TradFi being built on crypto rails. So just to give some examples there, crypto on TradFi rails, that's essentially ETFs. Providing access there. We're seeing a lot more utility for crypto-based asset structure. So whether it's more yield on Bitcoin-based products, or even sort of use cases such as mortgages, for instance. So that's essentially something which is slowly going in that space. And then on the reverse side, I think the biggest use case there is sort of stablecoins. It provides kind of like liquidity layer and payment rails that are going off of it, as well as tokenization, which is quite key there as well. So in that space, we're seeing kind of like the growth of kind of just on-chain equities, commodities, I think a space which very kind of new and recent is pre-IPO based tokenized assets. So providing exposure towards private market-based assets. And just overall, a lot of it just converges towards providing access to the end user. Now, where that space is sort of headed is we're seeing kind of the advent of a super app emerge as part of it. I think this is currently being driven by a lot of kind of neobanks, fintechs, as well as crypto-based exchanges, just purely because they're best positioned to kind of adopt all these different product areas. And naturally, they've been the first to kind of go into kind of payment-based rails, provide exposure across a wide variety of asset-based classes. Whereas when you look at kind of your traditional institutions, they've been a bit slower just because of the fact that they kind of wait for regulation, and that's just what the kind of user base and institutions essentially mandate. Now, one thing important to remember is that this is all very much an access-based convergence as well as a UX-based one, so providing exposure. But when it comes towards the asset classes itself, they will remain different. So in terms of let's say how you value a token versus like an equity and so on, that will continue to remain different, and something which I think will continue to drive discussion, conversation, even though if they all remain in one kind of asset base, just to provide different investors exposure to that asset class.
Which one matters more, or like which one do you think is, I guess, more important, and which direction is moving faster, crypto to TradFi or TradFi to crypto?
I think naturally, just because of crypto can operate a lot more, let's say, quicker and more nimbly, it's been crypto to TradFi. And we've seen it in terms of the growth in terms of the product spaces, right? So when we look at like stable coins and tokenization, I think that has essentially seen very strong growth. And a lot of it has been stemming from the fact that the crypto industry has been able to push these use cases quite forward. And at the same time, we've seen kind of crypto exchanges list a lot of like TradFi based assets, and right now it's generating quite a lot of good volume. So even as recently, when we look at TradFi based perpetuals, the use case there is that you can get access towards markets in off market hours, and that's driven a lot of volume and exposure for investors that maybe they can essentially get access to and react to news and geopolitical like changes quite quickly in kind of the weekend versus if they weren't able to before. So crypto has been essentially the main driver of this push for sure.
Now you mentioned something very interesting, which is the super app thesis, right? And I think when Elon first bought X, a lot of people were talking about that. That's when I first heard that conversation. Like X is going to turn into the new WeChat. It's going to be a super app and everything. But like, who actually builds this super app? And is it coming? Is it like the Binance, like the Binances of the world from the crypto side of things? Or is it more like a JP Morgan from the TradFi side of things? Because people are so used to holding their money already in a JP Morgan. So it seems like the use case would be more adopted from the TradFi side of things, but crypto has that advantage on the speed and already kind of the expertise in that. So like, what's your take on that?
I think what probably will happen is it'll just be natural convergence towards where the expertise and advantages lie. So if you look at, for example, on the crypto side, a lot of it is down to crypto native assets. It's down to essentially, tokenization as an infrastructure, stablecoin rails, and so on. I think that's where the natural kind of expertise lies for crypto-based kind of exchanges and apps, and that's where I think the natural convergence will apply for them. Whereas on the TradFi side, I think it's more to do with the fact that they are essentially providing a lot more efficiency when it comes to stablecoins and access from tokenization aspect, and it's very much catered towards the existing user base and institutional based kind of adoption that want that kind of asset class and access to that product layer. So they will naturally converge towards that aspect. So overall, I think that space will just naturally converge towards where the existing kind of advantages lie, and crypto has the advantage of just being a lot more quicker and providing that convergence area, but that will be catered towards the audiences that currently deal and operate on crypto platforms versus the TradFi side. I think they will wait for just a natural discovery when it comes towards more mature infrastructure as well as the regulatory side, and that will then naturally evolve accordingly as well.
Yeah, absolutely. And we are kind of starting to see, these TradFi and these banks, operating on stable coins. They're moving on to the stable coins. I think HSBC, right? UBS. I think I've even heard JP Morgan throwing around that they want to build their own blockchain. So at what point do you think TradFi basically like out executes crypto at their own game with moving volume on these rails?
So when it comes to in terms of like moving all of the rails and in that side, I think that's slowly already taking place. But again, it's very much driven more towards institutional based use cases, and we're seeing sort of that naturally kind of evolve, and it's very early days though. From in terms of over executing, I think there will be a split in terms of what use cases that would look like. So when we look at kind of certain markets and regions as well as various use cases, I think crypto side, consumer to consumer transactions, whether it's kind of merchant-based adoption, a lot of crypto platforms are already quite advanced in terms of where they are from that perspective. Whereas on the TradFi side, I think B2B transactions, where we look at kind of use cases on it's corporate treasuries, for example, and so on. That's something which, more institutional-based use cases is where they will see that kind of expertise. So it very much will be split between, different markets, different kind of use cases, and that will then naturally consolidate towards specializing in terms of what crypto platforms do and what TradFi rails do.
Yeah, so let's dive into that too, because you mentioned these use cases, and at the top of this, you mentioned how the crypto market is maturing. So I think it's very important that we discuss, what's real, what's hype, right? And then you're obviously you can see into all of that. So like, what are you seeing? That's genuine sustained growth today in crypto? Like, which use cases are actually matter versus what's just like narrative and hype?
Yeah. So there's quite a few in terms of which use cases are like very relevant in this market, and they have changed over the course of the last few years. The biggest one, which I think is very kind of front and center, is stablecoins. I think that's basically been one which has had the strongest kind of use case and driven that kind of bridge between TradFi and crypto-based rails as well. The biggest kind of growth has been towards payment-based use cases. So whether that's B2B based, consumer to business as well. That's something which is naturally kind of growing just because of the efficiency that stablecoins provide as a payment-based rail. There are also new use cases that are coming on top of it. So we're seeing kind of slowly the conversation yield around corporate treasuries adoption in terms of just providing a lot more efficiency for how they deal with the operations and using stablecoins there. I think yield is a very important front end conversation, and that's where regulation side is currently kind of taking place with the Clarity Act, and just yield-based metrics for stablecoins. But overall, stablecoins is also very dependent upon what is seen in different markets. So, what like kind of USA versus emerging markets in terms of what the use case for stablecoins are, that also differs. So, very much in the USA, it's seen more as a financial-based infrastructure and something which I think is just making processing flows a lot more efficient. Whereas in emerging markets, payments and consumer-based adoption is already kind of seeing a lot more growth. And then in some markets, it's also seen as sort of digital dollarization, where it's sort of a lot of, especially in South American countries, seen as a way to get exposure to the dollar and try to kind of hedge against, if the currency is suffering from high-based inflation, which I think has been something that's impacted them. So it's something which is very much market-based dependent, use case dependent for stablecoins, but something which I think has been very, very promising for crypto. Now, one thing to also note for stablecoins is the second order effects that come on top of it. I think all these adoption cases that are happening, the important point and takeaway here is that it's essentially onboarding a lot of liquidity on chain. Even if it's for payment-based use cases or corporate treasury, for example, it's bringing a lot of liquidity on chain, and which is a very important metric for crypto markets in general. And what that does is that it just means that once that's the use case is there, the natural kind of next layer becomes talking about capital efficiency, talking about what more use cases can exist on top of just, let's say, stablecoins for payments. And that will lead to natural conversations around providing yield on these stablecoins on chain, more DeFi-based use cases that are also catering towards retail and institutions. And that just naturally means that there's more propensity for a lot of this like kind of new liquidity that's come from, let's say, payment-based rails to eventually flow towards crypto-based markets. So overall, stablecoins has been very, very positive and something that continues to drive the space forward.
One thing as well that we've kind of seen is, especially with like the geopolitics of it all, like Hyperliquid is absolutely like blown up because of, trading perps, right? And then, S&P, now they're talking about 24/7 on-chain perps, right? A lot of exchanges are talking about tokenizing stocks, right? So now we're getting into this, basically the market never closes. Is that a good thing? And two, what is the risk of moving this fast and having 24/7 markets?
I think there's basically a conversation on both sides for sure. So to begin with, when it comes towards access and 24/7, I think crypto exchanges have been able to kind of demonstrate that, as well as Hyperliquid. When we saw kind of geopolitical based tension recently, and that required kind of just risk off and sentiment kind of adjusted accordingly. We saw that adjustment and reaction happen a lot quicker in terms of these TradFi-based perpetuals assets. And that then reflected eventually towards your standard TradFi-based asset classes. So that 24/7 access has been a key moat, and something which I think is that TradFi markets are looking towards also adopting that trend. We're seeing a lot of institutions talk about it. We're seeing Nasdaq and kind of the stock exchanges themselves wanting to tokenize and provide a lot more kind of access across the board. So that's just been a natural layer that will evolve. I think the challenges there, as you rightly mentioned, was the main risk tends to be price discovery and liquidity. So right now the liquidity is still pretty young. It's a new kind of space. So what that means is there's still some disparities in terms of the price that's kind of sometimes quoted on, especially on-chain like tokenized-based metrics versus what ends up being on the kind of equity-based markets, and that will naturally resolve once more liquidity enters the market. And that's something which I think the takeaway there is that these markets provide somewhat of an indicator towards where volume is sort of moving. But eventually, the price discovery part still has to evolve, and that will require a lot more liquidity in the space, which I think will naturally evolve once more institutions and TradFi-based firms enter the space.
Now, speaking of what also is entering the space, we're seeing the rise of AI agents, and they're using crypto rails, right? And they're using stable coins and a whole bunch of things. How does that play into all of this? What does that, and then what does that say also about where these rails are actually headed when people are starting to spin up AI agents to operate on their behalf and execute trades and transactions?
That's definitely something which is a emerging use case in today's market. It's still very new. It provides this kind of new demand layer in the space. So when we look at kind of the agentic economy, essentially, a lot of it is driven by sort of crypto being able to provide the rails that allows these agents to transact. So naturally, I think these agents, when we look at kind of traditional bank accounts and requirements from a regulatory perspective as well KYC, that side becomes a lot more tricky for them to actually execute transactions on sort of their behalf. And that's where the use case of stablecoins and wallet-based products come into play, where agents can essentially execute accordingly based on that infrastructure. And that's why a lot of the focus in the crypto space has been towards evolving that particular infrastructure. And that's where we're seeing a lot more kind of investment as well as activity from a developer perspective in terms of growing that infrastructure out. Now, one caveat to mention here is that a lot of it is also dependent upon the natural adoption of agents. I think that's something which we're also just seeing and sort of kind of grow slowly across different markets and use cases. So whether it's kind of for commerce-based reasons, whether it's trading-based, as well as just general businesses adopting agents for different use cases, I think that will be the first layer in terms of just markets in general. And then naturally, once that kind of co-pilot phase is done, it moves more towards the side of executing transactions. So being able to then utilize payment-based rails and stablecoins and so on, which will then naturally translate towards more adoption and use case for the crypto side as well.
Now, speaking of stablecoins, we see in the headlines, like we see just an eye-opening number, right, of, volume from stable coins. But then when you dive into it, you kind of strip out the trading and the flows and the real payments are much less than that headline number. So I wanted to kind of ask you, what actually matters in terms of stable coin volume, and how do you identify what's signal with stable coin volume versus what's just headline noise?
Yeah, that's a very good question, and definitely an important metric that I think it's very much tracked across the board. So stablecoins, historically, they're used as more of this kind of stable asset as a trading pair, and very much kind of peer-to-peer. And that's something which has been kind of the essence of where they essentially came from. Now, the trading volume side, that dominates stablecoin usage. And these new use cases are something that's being a lot more broken down. And there's a lot more kind of metrics that are coming about in terms of adjusted volume to look at these specific use cases, whether it's kind of B2B based, whether it's kind of consumer purchasing on for the commerce perspective, even sort of when we look at just cross-border remittance and so on. So these use cases are definitely something which I think are individually being tracked. And that's quite important because that gives us a natural kind of attention towards what is essentially the growth and the use case of stablecoins outside of the traditional use case that we're always kind of used to seeing. But the good news out of that is that we've seen very strong growth in all of these different areas, and just to essentially indicate that this is something which is moving quite fast. And I believe that the strongest use case today is on the B2B side. But that's also naturally just because institutions drive a lot more volume, and that's kind of led to the B2B side being quite strong.
One big thing apart about a financial system, right, is debt and credit, and what happens when that starts originating directly on chain? Can you walk us through kind of what that process actually looks like?
Yeah. So is the question around like how debt and credit would essentially like be tokenized and kind of on the
Exactly,
chain?
yeah.
Yeah. So it kind of just goes through very similar in terms of how, let's say, you would tokenize like your general kind of equity-based products. So you'll have kind of like your issuer, you'll have kind of like your rails that connect the off-chain data to the on-chain side, and then your natural kind of security rails around it. So that kind of issuer framework, as well as creating the market for it, that remains pretty much similar. In terms of what that would look like, I think it's very similar towards what your natural markets for in the traditional finance sense look like as well. So when you're looking at kind of like private credit in terms of how that would exist on chain, a lot of the operating side in terms of what's done today, that would also need to be met on chain as well. And all those kind of like functionality and processes that institutions are used to, that infrastructure to accommodate for that will have to be built out. So that's going to take its natural kind of evolution in that side. One key aspect there is also kind of evolving the regulatory aspect so that there's clear transparency and visibility in terms of how these on-chain metrics kind of and assets essentially flow. Because institutions are obviously used to working in a certain way and metric, and there's thousands and thousands of legacy-based integrations. So all of that will essentially need to be catered for a lot of these new markets, whether it's kind of like private-based credit, whether it's money markets and debt and so on. This is something which I think is currently built in the build-out phase on the infrastructure side.
Mm. So let's talk about I guess kind of the elephant in the room, the important regulation that needs to happen for us to kind of move forward, right? That's something that you kind of touched on as well. Banks are they need that regulation to be able to move forward, and that's kind of what slows them down. So let's talk Clarity Act, right? That's the big one. What does it mean for the market if it passes, and what happens if it stalls out?
Yeah, regulation is definitely something which is front and center in this market. I think when you talk about what is one natural catalyst for crypto this year, it's been kind of regulatory trends and what the outcomes are from that side. I think that the current one in focus is, as you mentioned, is the Clarity Act. That's something which currently is in kind of undergoing debate, mainly from a yield perspective. I think that's been kind of one specific conversation that's been occurring. And just to kind of explain that side, it's mainly about how yield essentially rolls up towards essentially what can be provided by stablecoin issuers as well as crypto-based entities for if they're earning yield on stablecoins, how can that roll up towards a sort of a retail-based user who's earning it? So that whole concept of sort of being able to earn yield on an ADL-based asset, that's essentially what we're talking about here. Now, in terms of the hold up side, I think that naturally will kind of deviate and reflect in kind of price action. So what we've seen is that whenever there's kind of regulatory-based changes or announcements, we've seen markets react to that particular news, just because that leads to a natural kind of, whether it's kind of opening up access towards a certain area for more growth, or whether it's kind of leading towards more of a, let's say, a blocker for growth to essentially happen. And that's something which then naturally gets reflected towards markets, especially more so today, given the composition of buyers are institutionals and they value that side a lot more. So yeah, Clarity is definitely one of them. And to really kind of give another example about how regulation is really driving markets, we can take an example from the Genius Act last year. I think once the Genius Act was essentially approved and sort of passed through towards being an actual regulation, that's essentially the first major catalyst that drove the stablecoin based kind of adoption and volume across the board. And that's something which we've seen in terms of regulation being a natural driver for stablecoin-based adoption. And that will be the same for tokenization and as well as other major use cases. So yeah, in terms of this market that we are in today, regulations is definitely something which is you can think of it as a natural driver of crypto markets and a natural catalyst as well.
Now, I think the market tends to think, the minute the Clarity Act gets passed, that the next day crypto rails are going to be free flowing and everything. How does that actually work though? A Clarity Act gets passed, from your kind of viewpoint, when do you see that actually coming into play with the results of the Clarity Act being passed? Are institutions ready to go right now? They have all their ducks in a row? Or is it more like this gets passed, then we figure out based off of that and might not start seeing the effect of it a year or two later?
Yeah, that's a good question. I think based on, so for this, we can extrapolate what sort of happened in prior regulatory passings and regimes there. Given the market composition are kind of based very much institutionally driven, there tends to be a lot more structured approach to things. So in terms of what sort of takes place, it very much firstly depends on what the final outcome is of that particular piece of regulation. And that will be what is the focus point in terms of what product needs to be built out or what sort of use case institutions essentially want to cater and adopt for. So that's obviously going to be dependent upon what regulatory aspect is kind of passed. The second part is that it wouldn't be kind of immediate per se, but I think we'll see it as a natural kind of progression towards what sort of is essentially deployed from a adoption-based perspective. What is probably more immediate in terms of reaction is what will get reflected in terms of just how crypto markets are valued in general. So that's more from a pricing perspective. Whether it's sort of reflected across crypto markets as well as equity markets in terms of the natural kind of like public companies that are based on crypto rails that have essentially operating that market space as well. So from a pricing standpoint, I think that's where it gets naturally kind of positioned in terms of how people are positioning for the growth of the space. But in terms of product-based use cases of adoption, that will be very much kind of a structure-based approach and also driven by different use cases and market structures.
Now, little bit of a different topic here, but I think one that maybe the regulation should consider at some point, because I've seen the rise of, I guess, quantum risk. Are you seeing anything like that coming up in the data where, it's quantum risk is a potential vulnerability for Bitcoin? Is that relevant in the market right now from what you're seeing in data, or is that something that maybe we're getting a little ahead of ourselves?
So quantum risk is something which I would say that it's been in the conversation for a while now in the background. Particularly this year, it's been accelerated, particularly from I think there was a research paper from Google that essentially talked about various different aspects about the quantum risk, and there might be a lot more kind of closer towards the risk being realized. And that's led to a lot more ongoing debate and discussion in the industry. In terms of what we're seeing take place as a result of that is there's all development-based discussion. So it's like solution-based metrics, not just for Bitcoin, but also for your general purpose layer ones as well. But on top of it, I think what we'll start to see is that this risk will start being priced in towards how far a particular, whether it's Bitcoin or a layer one kind of chain, how far they are in the progression of becoming quantum resistant. And that kind of risk-based premium is something which will start to be reflected in the pricing of that particular asset class. I think it's still very early days, but something which will definitely be the case going forward in today's market.
Yeah, absolutely. Now, and I guess to kind of touch on that while we're on the conversation of risk, like DeFi, right? There's a risk in DeFi, and we touched on it with bridging, right? And all those different vulnerabilities that can be attacked through, kind of all of that fragmentation. We've seen that a lot recently in the news. Is that getting priced into the market right now? Are you seeing that in the data?
Yeah, it is definitely, and it's being priced in various different aspects as well. So I think with the recent, just to give some perspective, firstly, we've seen kind of April have one of the largest kind of like months in terms of exploits since let's say early last year. But it's been one of the largest from an instant count perspective as well. So DeFi risk is something which has also led to more debate and discussion in the industry. What the natural kind of reaction to that was, so firstly, we saw liquidity on chain across DeFi protocols. We saw an outflow from there. So that's just led to kind of like the total value lock metric on chain that's been impacted. There was a natural kind of hit for various based like DeFi based assets in terms of like pricing. And the secondary effect has been sort of more about like a discussion around how to mitigate for this going forward. So that's front and center in terms of conversation for how that takes place. I think there's various different approaches that are being discussed, whether there's more of a kind of market-based recovery fund, whether DeFi yield itself, it's not pricing this risk correctly, and whether yield needs to be maybe more attractive from that viewpoint. And then there's also use cases around insurance and so on. So all of this will naturally play out in terms of what's best for innovation in the space. But I think one thing I do want to kind of draw attention towards is the whole concept about DeFi yield and the risk side there. That's currently front and center in that debate. So one of the reasons for that is essentially, so DeFi yield has been driven by various different on-chain based catalysts and so on. I think what we've seen is there's a natural spread between DeFi-based yield, as well as if you look at the risk-free rate, which is treasury-based yield. And these days, given interest rates have kind of essentially gone up, that spread has decreased over time. And at the same time, what we've seen is that there's a lot more demand for yield, whereas there's a lot less demand for borrowing on chain, and that's also led to effectively more more people wanting to kind of just find more capital efficiency for stablecoins, whereas more people wanting to borrow on chain. And that's just been a natural effect in terms of what we've seen with the other use cases that I've talked about, right? So when we look at kind of stablecoin adoption, a lot of it is very much driven about holding stablecoins on chain. But the borrowing market and money market side, that's still, you could argue, it's a bit more mature, less mature than the stablecoin space. So these are just things that have created, a certain dynamic, and it's leading a lot of like discussion in this space. And a lot of it will naturally just evolve as adoption grows, use cases grows, and yeah, a lot of these incidents and episodes stem as kind of like a foundation for the crypto space to essentially just innovate, to use as a learning curve, and then just build the right products and continue going forward.
Yeah, absolutely, Malik. This has been such an illuminating conversation. But I want to leave off with one more question, because you're inside Binance, you see the data, you know what the institutions and retails are actually doing versus what they say they're doing. So what's like one thing you wish more people in traditional finance kind of genuinely understood about this moment that we're in crypto markets?
Yeah, that's a very good question. I think it's also a question that probably has a lot of different answers that can be put forward for that. In terms of what I would say, from that side, it's mainly from a perspective of understanding the different use cases in crypto, and how crypto assets are valued. I think there's still a bit of disparity towards how, let's say, a particular token should be valued, and where that value accrual essentially comes from. I think when you look at traditional market investors, they're a lot more used to earning call based approach, like in terms of the performance of a company. They're used to cash flows and so on, like very traditional metrics that they utilize. So the crypto space is a whole new world in terms of how things are valued, and that's where we're seeing the growth of just more transparency towards value accrual mechanisms, token based investor relations, and so on. And that's something which I would recommend that to pay and keep tokenomics front and center in terms of visualizing towards how that looks like, understanding the role of a token in a particular protocol, what that means, and how value accrual is essentially done, and the fact that these tokens are built on very different dynamics for how value does get accrued, and it's both from a demand side as well as a supply side. So yeah, these is something which I would say for traditional market investors to definitely kind of sort of put forward their attention towards.
Well, Malik, it's been a pleasure. Thanks again for joining us, and thank you everyone for tuning in. This has been another Real Vision Masterclass with Binance. Thanks again, everyone. We'll see you for the next one.
So you obviously like this video enough that you've got to the end. That's quite a big task. But listen, do me a favor, hit the like and subscribe button, and also check out what video's next, because I think you'll love it. But if you want even more, and when I'm talking more, I'm talking about member-generated ideas, incredible alpha, research, everything there to help you in your journey. Just head to realvision.com/join for the best financial intelligence out there and the pure alpha that's within the platform.